Banks in the banking industry work. Banks, whether they be brick-and-mortar institutions or online-only, manage the flow of money between people and businesses. More specifically, banks offer deposit accounts that are secure places for people to keep their money. Banks use the money in deposit accounts to make loans to other people or businesses. In return, the bank receives interest payments on those loans from borrowers. Part of that interest is then returned to the original deposit account holder in the form of interest, generally on a savings account, money market account, or CD account. Banks primarily make money from the interest on loans as well as the fees they charge their customers. These fees can be tied to specific products, such as bank accounts, or related to financial services. For example, an investment bank that offers portfolio management to investors can charge a fee for that service. Or, a bank may collect an origination fee when granting a mortgage loan to a home buyer. Banking is a highly regulated industry. The Federal Reserve System oversees banks and other financial institutions and coordinates with state regulatory agencies to help ensure banks follow the proper guidelines. Banks are also subject to regulation by other federal agencies, including the Office of the Comptroller of the Currency, OCC, the Office of Thrift Supervision, OTS, and the Federal Deposit Insurance Corporation, FDIC. The FDIC does many things, but one of the most important for banking customers is insuring deposits. The FDIC insures deposits at banks for up to $250,000 per depositor per insured bank for each account ownership category. This means if your bank fails for any reason, the FDIC can help you recover the money in your accounts up to the allowed limits. Types of banks. Banks aren't identical, and several different types of banks handle financial transactions. These include central banks, retail banks, commercial banks, investment banks, shadow banks, savings and loan associations, credit unions. Central banks manage the supply of money for a country or group of countries. These banks are responsible for setting monetary policy, overseeing the movement of currency, and establishing interest rate baselines. In the U.S., the Federal Reserve is the central bank. Retail banks are probably what most people think of when they think of banking. These banks offer loans, deposit accounts, and other banking services to everyday customers. Retail banks can be brick-and-mortar institutions with branches or online banks. Commercial banks typically cater to businesses or corporations, although they also can serve the needs of individual banking customers. Similar to retail banks, commercial banks also can make loans and offer deposit accounts and other banking services. Investment banks can take part in securities trading, manage investor accounts, or do a little of both. An investment bank can act as a go-between for investors who want to put money into the markets by helping with the purchase or sale of securities. They also can offer investment advice to clients. Shadow banks aren't like traditional banks in terms of what they do or how they're regulated. These non-bank financial institutions are generally unregulated and primarily focus on making investments in credit and debt instruments. Insurance companies and hedge funds are examples of shadow banking institutions.